Hello, welcome to another episode of the Capital Employed podcast. Joining me in conversation for this episode was Adam Wilk from Greystone Capital Management. Adam takes concentrated positions in small companies that are generally underfollowed, misunderstood, and can be too small for large funds or passive investment vehicles to own, therefore creating the potential for mispricings. He is someone I keenly follow, so it was great to have him on the podcast to talk through his investment style. Adam also talks about two companies he has invested in, which he thinks have great long-term potential. I really enjoy listening to him, and I think you will too. Before we jump into this episode, do make sure to add your email to the Capital Employed email list. We will be publishing some exclusive interviews that will only be available to those on the list. To receive these bonus episodes, please visit capitalemployed.fm/exclusive and add your email to the list. Okie dokie, on with today's episode. Please enjoy my conversation with Adam. Hi Adam, thanks for coming onto the podcast.
You're very welcome. Thanks a lot for the invite.
Can you give an overview to Greystone Capital and what is the investment philosophy and investment style?
Sure. So Greystone Capital is a long-only equity-focused registered investment advisor. And the firm was founded in 2019, with 2020 being the first year in operation. And prior to that, to back up, I'm the founder and portfolio manager. And prior to founding the firm, I was managing friends and family money and working in banking in addition to a stint in the sports world. Greystone Capital was really founded to take advantage of some of the interesting opportunities in small and microcap securities. As I mentioned, I have a long-only strategy, so I run a pretty plain vanilla portfolio. The portfolio is very concentrated as I'm trying to build a group of investments that I have high conviction on that are based on deep fundamental research and getting to know in a familiar way the businesses and the industries in which I'm investing in. I guess to combine sort of the philosophy and strategy for Greystone, my investment philosophy is based on a couple of core beliefs, some of which are that investing in a concentrated way is a more beneficial way to generate outperformance. The market will occasionally offer shares of businesses at a discount. That volatility is not investment risk, but it can be used by the knowledgeable investor. That having a long time horizon leads to success in investing. Those beliefs are really put into practice through my strategy, which is to really search for wide mispricings along my universe of businesses, only deploy capital when I find them. So I will say no to most ideas in the pursuit of building a concentrated portfolio. Clients will typically own maybe 7 to 12 stocks at a time. And again, those are businesses that I understand on a very deep level, that I've done a lot of fundamental research on, and where I understand the industries. And then again, for new ideas, I will only be deploying capital when a severe mispricing exists. And what I'm trying to achieve is to generate returns in the neighborhood of 15 to 25% over a 3 to 5 year period. So on an individual stock basis, what that might look like is a stock that doubles in a period of 3 to 5 years. My favorite types of businesses to do that are small and microcap securities. And again, that's kind of my favorite fishing pond.
Okay, and apart from looking for the mispricing in the value, are there any other business characteristics that you look for?
Yeah, that's a good question. There are a lot. I have a pretty strict investment criteria, and along those lines, I'm trying to sort of check some boxes for business characteristics that I like to see, some of which include recurring revenue businesses. I really enjoy businesses that don't have to sort of start from zero at the beginning of each year in order to generate their revenues, even though I certainly own some of those. I like businesses with operating leverage that as they grow their revenues, their margins can enhance based on efficiencies within the business. I like companies that generate a lot of cash flow. And again, that kind of ties into the operating leverage, where as a business grows, they become more profitable. I spend a lot of time looking for certain qualities of management teams, namely, I like to see high insider ownership, where a a management team might own a large chunk of equity relative to their compensation. But then there are a lot of other characteristics that we could probably talk about, spend a lot of time talking about. But really, what I'm looking for are businesses with some of those characteristics, including the recurring revenue, the chance for margin expansion, the revenue growth, the cash flow generation, and I want to kind of tie that into maybe having some secular tailwinds within the industry where the business has a long runway for growth, something that maybe dominates a niche product or service category and serves as kind of a leader in that category. And again, a management team that I feel is aligned with myself as an investor, given that I'm not able to own the business directly and serving as a secondary investor. We want to be sort of invested alongside good people and smart capital allocators and people who try to avoid doing dumb things with the money because it is made up of their own, again, with that high insider ownership. So, and then if I can find all those pieces in place, and there's a reasonable path to hit my return target that I mentioned before, it usually makes for a pretty good situation. And outside of that, I really want to make sure the downside is protected, whether it's a clean balance sheet that the business has, cash flows, as I mentioned. There's a really wide disparity between how they're valued and maybe a competitor or a group of peers, and anything along those lines where you might come to the conclusion that it could be difficult to lose money in the short term. And again, all those factors kind of put together could make for a pretty interesting investment to at least research more.
I received your most recent quarterly letter the other day, and I thought it was a great read. So many interesting companies. Can we talk about two of those companies in your portfolio that you're quite excited about, you feel have got great long-term potential, and what was the thesis for investing?
Sure, yeah. So I can start with RCI Hospitality. The ticker symbol is RICK, R-I-C-K, and full disclosure, I still own that. I actually didn't provide a long update in the letter about them, but it's something I've written about in the past and a business that I'm pretty bullish on moving forward. And although the stock has done really well over the last year or so, I still feel that there's still a pretty credible path to me for the shares to appreciate pretty significantly over the next year or so. And I would say that from the COVID period, the business is in a much better position than they were. They're in a much better position today than they were maybe, say, March or April, May of last year. So at a sort of a high level, RCI Hospitality is a owner and operator of gentlemen's clubs and a restaurant concept around the country. The nightclub segment is a really good business segment that generates a ton of cash, and they have sort of local monopolies for the clubs because, number one, in order to build a gentleman's club, you have to receive a license from the state or municipality. And most states aren't granting new licenses for these clubs. And so RCI is kind of grandfathered into their existing locations with really no or very limited competition springing up. So it's kind of an interesting little moat that they have around their nightclub segment. In addition, they own all the real estate under the clubs, which eliminates sort of landlord risk or anything happening where they're not in control of the actual property. And furthermore, most of the debt of the company is tied to the real estate, so they can continuously refinance it and search for lower rates and sell off assets if they need to and monetize it. So it's a very interesting setup and efficient setup. And basically, the company has historically taken the cash flows generated by the clubs and reinvested them into either more club acquisitions, repurchasing shares, or how I mentioned before, their emerging sort of restaurant sports bar concept called Bombshells, which is a military themed sort of Hooters style restaurant, although it's a bit different. They serve lunch, dinner, and have a bar service late into the night. Both of the segments, especially the nightclubs, have very rapid payback times for new clubs and acquired ones, and really phenomenal returns in terms of cash on cash yields that they get when they buy a new club or when they open a new Bombshells restaurant. With RCI Hospitality, the basic thesis is that, again, the nightclubs are really cash generative and they have a strong moat around them, and then they can use the cash from generated from the clubs to reinvest in the business at high returns, to open more restaurants at high returns, or to repurchase shares at high returns. And they have a CEO in place. His name is Eric Langan, who has been operating the business for over 30 years. This is his life's work. He bought his first nightclub after selling his baseball card collection for like $40,000 or something, and slowly built up the business from there. And I would say that at this stage right now, they're really at an interesting point in their history, because not only is the business chugging along, and the management team has really not only learned from past mistakes, but is really focused on growing the per share value and free cash flow per share moving forward. But a lot of their competitors and people within the industry were really decimated during the whole COVID period, which RCI navigated beautifully and survived and came out thriving from the whole pandemic, which, in some level, they're still kind of dealing with. The industry, from what I understand, has really changed, because a lot of these, the industry, I can take a step back, is made up of mostly mom and pop nightclub operators, and nobody with the scale or the buying power or the capital that RCI has. And so when they go to make one of these acquisitions of another club, they can really serve as the preferred buyer of choice, because they can offer seller financing. There's a number of other factors that make it very easy for them to kind of roll up another club that into their own into their operations and continue to collect the cash that it generates. And so now, with sort of the industry landscape changing because of COVID, I would think that they have a real opportunity to step up and start buying really good assets around the country, maybe using stock as currency or cash, and again generating those high cash on cash returns, which would further increase the free cash flow per share and the per share value, which would probably cause the stock to rise even more, which would result in good returns, but would also lower their cost of capital and enable them to use equity to continue to make acquisitions and open new Bombshells restaurants. So, as I mentioned in the beginning, although the stock is up a lot, I think there's still that's sort of a high level summary, but I think there's still a pretty credible path to the shares being worth a lot more moving forward, especially as the business grows and they continue to execute on their capital allocation plan, and the market continues to take notice. So I think it should work out pretty well over the next 12 to 18 months.
Okay, and how about your second stock to talk about?
You mentioned my letter, so I entered into a sort of mid-sized position in Playboy Enterprises during the quarter, which I'm sure everybody is familiar with, which was originally Playboy went public via SPAC and a special purpose acquisition corp, and the deal to take them public was consummated in February, and the group that took them public rolled over most of their equity into the new Playboy, and the shares now trade under the ticker symbol PLBY. This is a really interesting situation, because from where I was sitting, the post deal price for Playboy was very cheap relative to what I believe the brand value is and what I think the business can accomplish. It kind of made for an interesting opportunity, because I felt like not only were investors not really paying attention, but there was a bit of a historical overhang on the stock where people can only associate the brand with the magazine and the publishing business, which is very far from these days. And in fact, the publishing business no longer exists. The company was founded in the 50s by Hugh Hefner, which I'm sure everybody is familiar with. I probably don't need to get in too much into the history, but like I mentioned, it's definitely not the same business that existed in the past. The publishing arm and the media arm no longer exists. And the company today operates consumer product categories in really large markets, and there's no clear leader in those markets. And they also have a licensing business that that has licensing revenue, revenue of $400 million that's contracted through over the next 8 years or so. Right now, they're focusing on growing that direct-to-consumer segment, and they want to drive new customer growth, and they want to do so by leveraging their social media followers and doing some bolt-on acquisitions and changing up the licensing deal structure, which should hopefully lead to the growth in revenues, margin expansion, and then free cash flow generation. And leading the charge here is a group of really talented managers, one of which who has been involved with the brand and the company for over a decade, and worked with a private equity group before taking the company public today. He worked with a private equity group to take them private back in 2011. And the basic thesis is, I mentioned the business, they're trying to grow their direct to consumer offering, which should hopefully have the benefit of taking some of these licensing deals and bringing them more in house so that they can collect more than pennies on the dollar in terms of a take rate for all the licensing revenue they generate. And Playboy is, I guess most people wouldn't know this, but they actually generate an incredible amount of licensing revenue overseas. They're huge in China, and they do something like 3 billion in annual licensing revenue globally. And again, the idea is to take some of that and to bring it in house and to kind of take back ownership of the brand so that they can capture a little bit more upside of some of these deals. And the thesis with Playboy was, in addition to the cheap deal price and sort of the mispricing there, was that this is a business that is now sort of freed from the historical shackles that that were placed on it with the old chairman and his family and some of the other people involved, where they wanted to keep the magazine alive and the publishing business, which was just sucking cash from the company, and there wasn't money to invest in marketing or to reinvest back in the business or higher return initiatives. And now that that's done, you have this new management team in place that has been involved with the brand for over a decade, that's ready to monetize it, and that's kind of chomping at the bit to take the cash flows that the licensing arm generates, among other things, and reinvest them back into higher value initiatives. And so they have a lot of going public provided them a lot of cash to do that. They're no longer tied to the publishing arm, and they have the resources and willingness to sort of deploy that capital into things like M&A and marketing and things like that. So, I mentioned in my letter too, you can kind of look at case studies for building a brand and leveraging social media following to do that, in addition to the value of some legacy, iconic people and licensing arms. And Playboy is right up there with them in terms of having a really strong archive of intellectual property. They bring a lot to the table in terms of being able to monetize their brand, which is one of the most recognizable brands in the world. So looking at the initial deal value just seemed kind of silly, and we were able to buy shares at a little bit above the post-SPAC deal price, and it's worked out well. Obviously, the stock has gone a little bit crazy, but I would say that even adjusting your numbers a bit and the valuation, there are a lot of paths to do really well here as the management team does their thing and they continue to monetize the brand. And I would say over the next 3 to 5 years, the company could look very, very different than it does today. And there's a good opportunity for decent returns moving forward.
Yeah, it's a fascinating story. Just briefly, what are your thoughts on the valuation of it? 'Cause as you say, it has gone up quite a lot in a short space of time.
Yeah, very good question. I mean, I think it's, well, number one, it's a hard business to value because it's hard to put a value on a brand like that. Traditionally, if you want to, you can use sort of some of the traditional metrics, and I guess EBITDA is the metric that the company's using. And when I first came across the business, they were very cheap, something like 12 times next year's EBITDA or something along those lines. That was growing pretty fast. But today that's changed a lot, obviously, with the stock over 50 or something. I think the market has definitely pulled forward a few years worth of returns, and the expectations are a lot higher now. So it's a little bit different. But management put out this interesting 2025 guidance to try to hit 400 million in revenues. To try to hit 300 million in revenues and around 100 million in adjusted EBITDA, which would put the valuation at somewhere around 20 times or so today. I would say that guidance ends up looking pretty conservative, and I think I could see them finishing 2025 with well over 400 million in revenues, and if they can hit their adjusted EBITDA margin target of, I believe, 30%, they'd be generating somewhere around 120 million in adjusted EBITDA, which would obviously make the valuation more attractive. But I definitely think now expectations are higher, and it's a little bit more of a sort of show me story for the market, but they seem to like what is taking place and what the management team is saying. So we'll have to see how they can kind of grow into their valuation.
Okay, thanks, Adam, for sharing those two stocks. So where can listeners go to find out more about you and Greystone Capital?
So there's a couple places. You can visit our website at www.greystonevalue.com. Greystone is spelled Grey. I have a blog where I post research and investment ideas. That's poundtherockinvesting.wordpress.com. And then I'm on Twitter my handle is at AKWilk, WILK. And I also have a firm specific Twitter, which is Greystone Capital or Greystone Cap. Again, Greystone spelled Grey, but listeners of yours are more than welcome to reach out, send me a message. I love to talk stocks, ideas, all that kind of stuff. So, I can be found at all those places.
Okay, then that's great. Yeah, thanks so much for coming on to the show. It's been a pleasure to listen to you. You uncover so many interesting little stocks out there that hopefully we can get you back on in the future to discuss some more.
Yeah, absolutely. Thank you very much for the kind words and for the invite.